let's just jump right into it. Today, we're unpacking a brilliant anonymous expert analysis in this explainer that totally fundamentally shifts how we need to look at our business finances. We are moving from simple, boring tax compliance to a proactive wealth strategy. If you've ever wondered why some high-income earners seem to just completely bypass massive tax burdens while others get totally crushed, well, the answer is in the architecture of their financial decisions way before tax season even starts. So I want to start off by challenging a really common assumption. A lot of us think, hey, if my taxes are filed with 0 errors and the software gives me that little green check mark, I'm definitely paying the optimal amount. But as this analysis reveals, that is a wildly costly illusion. See, a correctly filed return literally just means you've accurately reported your historical data to the government. That's it. It has 0 correlation with whether your actual financial structure was efficient in the first place. To put it perfectly, this expert report points out that compliance and optimization are 2 completely different things. Just staying out of trouble with the IRS doesn't mean you aren't legally handing them tens or maybe even hundreds of thousands of dollars more than you need to. Compliance is just avoiding penalties, right? But optimization, that's about keeping capital inside your operations where it belongs.
So, we're going to break down this trap logically today. We'll start with the correctly filed illusion, look at the default structure trap, decode the incentive playbook, dive into the power of paper losses, and finally, wrap up with executing a proactive tax strategy.
Okay, Section 1, the correctly filed illusion. Let's see why basic software and just aiming for compliance is probably costing you an absolute fortune. The stark contrast here really boils down to timelines. Tax accounting, it's inherently backward-looking. It literally just documents what has already happened to you. Tax strategy, on the flip side, is totally forward-looking. It is the active, intentional process of engineering exactly how your income will be earned, structured, and timed before the year even ends. If you're only focused on accounting, you're essentially just accepting the default maximum tax rate applied to whatever you made. The report zeroes in on this. Defaulting to DIY platforms means you are playing a purely reactive game. Those platforms, they're not going to tap you on the shoulder and say, hey, your legal entity is leaking cash. No, they just calculate the math of that leak really perfectly. And this is exactly why so many scaling businesses get hit with massive surprise tax bills. You miss out on the forward-looking strategies that actually protect your cash flow simply because the software is built to satisfy the government's requirements, not to build your wealth. Which brings us to Section 2, the default structure trap. This is a massive hidden leak for growing businesses. The core issue here is understanding how the default LLC actually works. Tons of founders set up an LLC for liability protection and just automatically assume it's tax efficient. But by default, all the profits of a single-member LLC pass straight through to the owner. This makes every single dollar subject to a very heavy burden known as the self-employment tax. And that burden is exactly 15.3%. That is the dreaded self-employment tax rate. And remember, that's literally piled on top of your standard state and federal income taxes. So in a default LLC, if your business clears $150,000 in profit, that entire amount gets slammed with this extra 15.3% tax. It creates this totally invisible ceiling on your growth. But look at the cause and effect here. By proactively electing to be taxed as an S-Corporation, you literally change the legal mechanism of your income. You can actually split that $150,000 profit. You pay yourself a reasonable salary, let's say 80 grand, which gets the payroll tax, but the remaining 70,000, you take that as a distribution, which completely bypasses that 15.3% tax. Just by changing the structural container of your business, you plug a huge financial leak. All right, moving on to Section 3, decoding the incentive playbook. We're going to completely reread the tax code. This concept changes absolutely everything. The experts make it super clear. The tax code is not just a list of penalties designed to punish you. It is actually a behavioral roadmap. The government uses the code to partner with people who solve societal problems. Think about it. If you provide housing, if you create jobs, if you invest in energy, the government is going to reward you heavily for taking on that financial risk.
You can really see who the system favors here. Standard W-2 employees are way down at the bottom, mainly because the government has already secured their tax revenue through automatic payroll deductions. Plus, they aren't really taking personal financial risks to create jobs or housing. Business owners rank higher, for sure, but real estate investors, they sit at the very top of the hierarchy. The government desperately needs private capital to build and maintain the housing supply, so they offer absolutely unparalleled incentives to the people who step up and do it. Let's dive right into Section 4, the power of paper losses and how you can utilize real estate to offset active income. Okay, to really grasp this, you have to understand the concept of paper losses. Now, we're not talking about a bad investment where actual cash is draining out of your bank account. No, this is a highly sophisticated accounting mechanism. It essentially allows you to legally show a massive loss on paper, usually driven by depreciation or the wear and tear of a building, while at the same time, the property's actual market value is going up, and the rental income is putting real cash right into your pocket. And here's how you accelerate that timeline. Normally, the government forces you to spread that depreciation deduction out over a painfully long 27.5 years. But the analysis points to a brilliant mechanism called a cost segregation study. This lets you categorize non-structural stuff like flooring, appliances, fixtures, and literally pull decades of their depreciation forward into the very first years of ownership. The result? A massive immediate paper loss. But here's the non-obvious, real expert-level detail. Usually, real estate losses are considered passive, meaning they can only offset other passive income. If you're a high-earning W-2 employee or an active business owner, that doesn't really help you much. So what's the workaround? Short-term rentals. If your average guest stay is under 7 days and you materially participate in managing the property, the tax code completely reclassifies it. Suddenly, those massive real estate paper losses can be used to legally wipe out the taxes on your active primary income. It's a game changer. To put some real numbers to this, the report notes that on just a $500,000 property, this accelerated depreciation strategy can generate a first-year paper loss of roughly $120,000. That is an accounting loss big enough to entirely neutralize the tax burden on a six-figure salary. This right here is exactly how the wealthy legally drop their effective tax rates down to near zero. Finally, let's hit Section 5, Proactive Tax Strategy. Here's how you actually execute this massive paradigm shift. The secret is honestly pretty simple. Savvy entrepreneurs do not wait for tax season. They establish these structures way before the revenue hits, because the foundation you set dictates exactly how every future dollar is treated. Think about it. If you wait until you're already highly profitable to change entities or set up a management company, the exposure is already compounded. You've already lost the cash. Proactive planning secures your capital up front so you can reinvest it into growth instead of just handing it over as a massive administrative penalty. Ultimately, this entire analysis boils down to a choice between two totally distinct mindsets. The filing mindset just passively accepts the defaults, treating taxes as an unavoidable, backward-looking chore. But the wealth mindset, it views taxes as the single largest controllable expense of your entire life. It's about actively, intentionally partnering with the tax code's incentives to engineer a predictable and highly profitable outcome. Which leaves us with one incredibly critical realization. Overpaying your taxes is entirely optional. It really is. It's a choice born out of sticking to a reactive system. So you have to ask yourself, are you actively designing your financial structure to leverage these incredible incentives, or is treating your wealth purely as an administrative reporting chore silently costing you a fortune?